My latest put on MSTY earned me 8% of my money in 1 month. That's on track for 96% in 1 year. Hello my friends, this is Legend. I just wanted to do a video just to kind of talk a little bit about my last put that I did. Just to kind of reiterate what I did, and also wanted to show that on my chart, on my spreadsheet that I had made up, and see what the changes are on that, and let's see where I'm at percentage wise. So here we are on the Webull chart for MSTY, and as you can see, it's pretty much from start to end here. We've had a lot of ups and downs, but overall somewhat flat, actually, right? Somewhat flat. So over the period on MSTY, it's went as high as $46.50 here, and it's been as low as $18.94. So we have gone way high, and we have gone below where we sit now. Currently, we are at about a $25.43. This is weekend, so this is after hours. Market's closed, and of course on Monday the market will be closed due to a holiday, but it will start right up Monday night for Webull at 8 p.m. We'll start the overnight hours for trading on Webull. So as you can see here, again, I like to look at the Bollinger Band, and you can see here on this Bollinger Band, we have the upper, we've got that mid, and we've got that lower. And as you can see here, the current candle is that green candle there. Let me enlarge it. That was Friday, and Thursday is when I actually sold that put. So as you can see, it was down below that Bollinger Band here. So that was a good time to sell a put, because the price itself is going to want to try to head toward that mid. By that price being below the Bollinger Band is a good time to sell a put, because what I'm doing when I sell a put, I am stating that I am willing to purchase shares at a certain price for a certain expiration date. In my case here, that price being at that $24.72 was the close on that Thursday. It opened at $24.75. So overall, the open and the close was pretty close to each other, although the low was $24.14 and the high being $25.09. So it did range a little bit, but overall it was down below that Bollinger Band. So that's a good time to sell, like I said, because I am stating that I'm willing to purchase those shares at a certain price, and I picked the price. So since that was ranging around that $24.75-ish area, I set my sell at the $24. Now that's not, I'm selling it at 24, but I sold a put. So I sold my put at $24, and the price being at $24.75-ish, give or take. But since it was so close to the money, being I was selling a put that was close to the current price, it paid me a higher premium for that. So I earned $2 per share times 100 shares per contract, right? And I only had one contract, so 100 shares. So that 100 times $2 gave me $200 for selling that put at a $24 strike. And I set an expiration of 1 month out for 3/21, March the 21st. Now, you could say that 1 month out would actually be probably March the 14th, right? Because if I look at my calendar here, we can see that we got paid on the 14th here, and this date here being the X date. So 4 weeks out, 1, 2, 3, and the 13th being 4. but I set it for this week. Now, anytime you sell options or buy options, it's always has an expiration date of that Friday. Okay, unless that Friday is a holiday, then of course it will be adjusted accordingly. But it's always on a Friday. You do have weeklies and you do have monthly expirations. So not all stocks or ETFs have both. MSTY currently has weeklies. And what I mean by that, let me go over here to my options chart and I can show you real quick that you can see here's February 21st, February 28th, March the 7th, March the 14th, March the 21st, March the 28th, and so on. This means here it's available weekly expirations. So I picked the 21st. Now, why did I pick the 21st? And that was just simply because, like I was showing here on the calendar, if it is going to go X on the 13th, then I don't necessarily want to have it expire, my contract to expire the next day. I'm thinking, and this is just my thought, is I'm thinking I will set it for 1 week after the X date week, okay, or declaration day, right? So I'm setting it for 1 week past. Now, I don't know if that's going to help or not against of getting assigned early or anything like that, but that's what I'm attempting for this one here. So I have that set at that March 21st currently, and at that $24 strike. And the reason I did that, as I said, is I am trying to sell my puts close to the price. And that would be close to the current price that it's at that time. The reason being is because that is going to provide a higher premium. And as you can see here, if I look at that March 21st, the current price of the stock is $25.43. That means that if I was to sell a put currently on that for a $25 put, I can earn roughly $2.15. But if I say I'm willing to buy it only at $24, so I'm adding a little safety in there, right? But that takes away a little premium. Now you're only going to get $1.35 per share times 100 shares times how many contracts you have, because each contract, one contract, equals 100 shares. And if you said $23, and I'm only willing to pay $23 per share on this date, then you only get $85. Now, I'm using this mid price over here. That's not guaranteed. That's what you can get because here's the bid, here's the ask, and the bid is 80 and the ask is 90, and the mid is the price in between the two, okay? And I'm just using this because it's just easier to talk about at the moment. So whatever price you put in there, the premium that you'll earn is adjusted accordingly, right? So the further away you go from that price, the less, say, likelihood of that price going there, therefore, the less premium that you would earn. But that's okay because you have to decide on what it is that you want for your premium and what are you willing to purchase those shares at. And I'm always looking to try to average down anytime I'm selling my put. And if I'm doing that, then of course I am looking to pick a strike, and these prices here are the strike prices. I'm looking to pick a strike below my average so that if I'm ever assigned, that would average me down, right? So if I've got an average of, say, $24 per share of all the shares I own, I don't want to necessarily sell a strike at 25. I may want to sell one at 24 or one at 23, right? So either one of those is going to help to bring my average price down. Now, a lot of people think, well, I'm just in it for the distribution. I don't really care about the price. But the way I look at it is, why pay more than you have to for the shares? So I would much rather get them at a discount than to pay top dollar for the same number of shares that someone else can buy and receive them at a lower price. But of course, in conjunction with that, anytime that price or that candle here is below that Bollinger Band, for me, that is a good opportunity also to buy more shares of the stock to own, right? So, and that's what I did as well. I did that. I did purchase a few extra shares that Thursday because that price had dropped below that Bollinger Band, and the RSI2 here on this yellow line had dropped down. So for me, it was a good time to also average down on my shares that I actually own. So if you're ever assigned the shares, say the price goes down below the price that you had set your put at, then you could eventually look to do the will strategy on it, right? And the will strategy means that you are selling calls and puts, right? So you may sell a put on a strike price for a stock for a number of shares, and if assigned at a certain price, say at $24 you were assigned at, then you can turn right around and sell a call against those same shares, but you would want to sell your call above what you paid for them. I mean, that only makes sense, right? If you paid $24 for them, you don't want to sell them for $23. You want to sell them for $25, right? So, you know, and you would earn a premium for selling a call against those shares as well. As you can see here, the current call price here of $26 for March the 21st, you could sell a call against 100 shares that you own. So if you have 100 shares currently and you want to sell a call against it, you could say, I am willing to sell my shares at $26. But for doing so, I require a premium paid to me of, let's say, $1.02. This being the mid, right? This is the mid. These are the bid and ask. This is the mid. But you can say, I'm willing to sell my shares at $26, but I am going to require a premium of $1.02. So you will earn $102 for potentially selling your shares at $26 out to March the 21st. Now, you can do that if, like I said, if it's a number of shares and say you've already reached your max number of MSTY that you're wanting to hold, because, you know, we can't just keep buying and buying and buying. Eventually, you got to get to a point where you're saying, okay, I'm a little heavy in MSTY. I don't necessarily need to be purchasing more, but you still want to sell a put against it, right? Because you still want that premium. So you can do that. And if ever assigned, then turn right around and sell a call above what you paid for them. And sell that call and get a premium for those shares. And if called away, great. You've earned your premium because you get that immediately. But then you also would earn the price appreciation because you've bought them at 24 and you sell them at 26 or something, right? So whatever that premium earned you plus the price appreciation is what you earn, right? Because you are now selling them at 26. So if the price of the stock goes to 27 and it is March the 21st, so that's your expiration date, and it's at $27 currently at that day, and you had your call, you sold a call at 26, then they will be called away and sold at 26, even though the price of the stock is $27. So your earnings is capped, right? You are capped on your earnings because you are stating what you are willing to sell your shares at. They are willing to pay you a premium to hold you to your promise of selling those shares at $26. So if it ever went to $30 or $33 and you had a call at 26, you still have to sell them for 26 at that expiration date. Now you can Over time, you can look to roll it out to April or May, and maybe up to say $27 or $28 strike, and earn a little bit of premium, just trying to capture some of that actual price that has gone up. You can try to do that as well. As time goes, it does get a little bit difficult to roll it, and you don't necessarily want to pay to roll. I don't necessarily, let me put it that way. I don't like to pay money to roll it, but I will take a premium and otherwise earn a premium to roll it up and out, up in strike and out in date, and that's on the call side. But that's only if you're assigned and you don't want the shares, right? You've already reached your quota on the number of shares that you're looking to hold, and these are extras because you are still selling your put and you got assigned. Just turn around and either set a limit to sell those shares at a certain price and just capture that and sell another put at that point, or you can sell a call if it makes sense, and only if it makes sense, right? You won't be able to always sell a call, but you can always put a limit order in to sell your shares at a certain price above what you paid for them, and that's just so that you don't get too heavy in a stock, right? And otherwise you don't own too many shares of a certain stock so that your portfolio is way overweighted on one particular stock. You don't necessarily want to do that, because if a stock does drop out, it does fall out or something like that, you don't want your whole portfolio to get hit that hard. So always keep in mind of that, and always do your own due diligence on keeping track of where you are at in your percentage of your portfolio for each stock that you own. So let's slide over to my spreadsheet now and take a look at that. So here we are on my spreadsheet that you've seen before on previous videos, and I just wanted to enter in what I purchased here and some premiums that I actually earned over here. Now I've got it set up to where I can show it with premium and not with premium. Okay, so the last we left off, we were at a 51.3% earned. Okay, so that's where we kind of left off there. So on that Thursday, which is 2/13, I purchased a total of 10 shares, and I purchased those at $24.50. So those 10 shares at $24.50, that's $245. And as you can see, that brought my percentage earned down. And why did it bring it down? Well, it's just simply because I purchased more shares, so more money was spent, but no more extra money was brought in, because currently right now I have my premium over here. I've got this set to no, do not show. All right, and as you can see here, right here it says 0, so it's not adding that in yet. Okay, we'll add that in and we'll see what that does as far as the change of that percentage. But we did earn distributions on Friday. Now Webull will end up paying me my distribution usually the next that Monday and sometimes that Tuesday. And since we have the holiday coming up, it won't show up until probably Tuesday. But we all know what the distribution is, and we know how many shares I had. So at the time that the distribution came out, and this distribution came out on February the 13th, and that amount that was paid, all right, so the amount that was paid is the number of shares times the per share distribution price. Okay, so I had the number of shares I had. Now over here it says 376, but that was because I already put in, or just now put in, those 10 shares on 2/13. Well, we know that I will not earn the distribution for those 10 shares on the 13th, when that is the X day, right? So those distributions here, and actually let me correct the date here, because that's the actual, that's the X date, but the pay date will be on the 14th, right? That would be the Friday. Now, the price here will be that 376 total shares here minus that 10 shares, because I will not get those distributions for those 10 shares because I purchased them on the X date. You must own them before the X date in order to get the distribution for the shares. So it's just simply 10 shares subtracted from the 376 was 366 shares. So that's how many shares I'll be able to get the distribution toward. So we can do an easy little calculation right here and just say equals 366 is the number of shares times what was the distribution amount? Well, it was 2.0216. So that gives me a total distribution that I'll earn of $739.91. So now already I'm at 57.73% earned. All right. Now, if I were to, and I probably should have put those shares in after the distribution. And so let me just take those out for a second and just see. So yeah, 59.25% that I earned on those shares that I currently had. But of course, I did purchase 10 more shares. So we will add those back in. So there's the 10 shares. And so we're at 57.73% earned on my money. Now, as everybody knows, if you watch some of my other videos, and if you haven't, make sure you check them out. I have a couple videos on selling puts, and I've sold a couple puts. So I sold one on February the 7th. It was a $25 put, and I'm looking at this chart right here. So I sold that February 7th, a $25 put, and that earned me $80. And the $79.92 is minus the fee. So roughly $80 for selling a put on the 7th of February. And that one will expire on the 21st of February. So that will expire next week. Then I sold another put on the 13th. That was X day. And I sold a $24 put and I earned $200. Right? Minus the fees, of course, is $199.92, but roughly, might as well say $200 I earned. So that's what I earned in my puts. So let's go ahead and add that into the calculation up here. And as we add that into that calculation, that's going to adjust my percentage earned over here. So let's go ahead and do that, and let's see. Right now we have 57.73% earned back on my money. And if I hit yes on this, it'll add it in and change my percentage. As you can see now, I've got 60.66%. Very nice. I've got the premium earned here, a total of $279.84. I've earned in distributions $5,517.49. My original capital here, $9,557.13, and the amount that I still have at risk is $3,759.80 because it is subtracting the distributions and the premium from my options earned out of the capital here, which is giving me that $3,700, and therefore that gives me my 60.66% earned back on my investment. Both of those numbers also affects and changes my adjusted price per share. So now my adjusted price per share is $10. Now, that basically, that $10 means that is my break-even price. And that would be using my distributions, my premium, and everything. If that price of the stock went down to $10 and I sold it at that point, that is me breaking even. I didn't lose anything and I didn't make a red cent, right? So I don't necessarily want to do that, but it's a good number to know, right? Because that also will tell me when I have earned all of my capital back. And that is kind of the goal here, is to get that capital back, and then I own the shares free and clear, and anything I earn above that is just pure gravy. So there you go. I'm at 60.66% now. That's awesome. I'm super excited about that. The current price of MSTY right now is about $25.43. My purchase share average is $25.42. So I am right there at the current price. Okay, so I'm right there at that current price. So when I purchased those shares at $24.50, that helped to bring down this average share price over here. Now, the average adjusted share price over here now is $10. And again, like I said, I've already explained what that is. So as you can see here, we're doing pretty good. And I kind of like the idea of adding these premiums in here and doing these options on the stock, because that is going to help to get this number up, this 60.66. That is going to make it go even faster. It's going to get my money back quicker, because as you can see right now, 60.66, and before, if I was not doing any options, I would be at 57.73. Okay, not a big difference, but I've also only done two little options right here. One of them was small because it was only for a couple weeks. And this one here was for about a month, so I got more premium on that. So I don't know about you, but this is pretty exciting to see. I love to see the numbers. I love to see the numbers, increase, and plus helps me to see and know where I'm at in the position. And that's something that you have to keep track of. You should always keep track of and know where you are at in your position. Are you making money or are you losing money? And with these high yield ETFs, it is a little hard to keep track of because you have the distributions that you're getting paid out here. So you got to keep track of that. And that'll tell you at what point that you've earned back your capital. And then therefore, anything above that is pure profit. So I think I'm going to wrap it up right there. I appreciate everybody for sticking around and watching and listening to the video. It's much appreciated. So please hit the like, subscribe, and share. And also, don't forget to hit the notification bell so that way you get notified when these videos get dropped. And as always, I am not a financial advisor. This is not financial advice. Please do your own due diligence before you get into any stock plays. And until next time, legend out.